In my opinion, he fundamentally hates humanity.
$1 billion. What would you do with $1 billion? Buy huge mansions? Fast cars? Huge yachts? Live on a permanent vacation on tropical islands? All this sounds great, but let's be real. You will never have $1 million, let alone $1 billion. If you get an average income of $37,000 per year, you would have to work 27,000 years to make this kind of money. But what if I told you some people can generate this kind of money from nothing? What if I told you someone made $1 billion in just 1 week? And what if I told you this same person now owns you? Not just you, but the whole society. Changing rules the majority is against, and bending the world to their will behind the shadows. This is the story of George Soros, the greatest speculator of all time, and how he became the man that owns you. What makes a man willing to challenge the established world order?
Soros, I don't know. I mean, he had a very difficult upbringing. In my opinion, he fundamentally hates humanity.
At what point does survival transform into an unbelievable drive for change? To answer this, we must journey back to Budapest in the 1930s, where György Schwarz was born into a prosperous Jewish family on August 12, 1930. His father, Tivadar Schwarz, was a respected lawyer and Esperantist, and the family enjoyed a privileged life. But this would not last. By 1936, the shadows of Nazi hatred were already looming. The family changed their name from Schwarz to Soros, adapting to survive in an increasingly hostile environment. Young Soros attended a private Jewish school, but even this privilege was stripped away when anti-Jewish laws began to take effect. Then, 1944 came. While children in other parts of the world were concerned with toys and games, in Nazi-occupied Budapest, 14-year-old György faced a reality that would shape his entire worldview. Most Jewish families faced an impossible choice: try to hide together or face certain deportation. But Soros' father chose a different path that would ensure their survival. Their family would split up, each assuming false identities. He bribed a government official to take in Soros and swear it was his Christian godson. Due to his godfather role in the government, Soros is said to have accompanied him in delivering notices and confiscating property of Jewish families. Those notes were actually a death threat in disguise.
My understanding is that you went out with this protector of yours who swore that you were his adopted godson.
Yes.
Went out, in fact, and helped in the confiscation of property from the Jews.
That's right.
Was it difficult?
Not at all. Not at all. Maybe as a child you don't see the connection, but it created no problem at all.
No feeling of guilt?
No. There was no sense that I shouldn't be there, because that was well, actually, funny way, it's just like in markets, that if I weren't there, of course I wasn't doing it, but somebody else would be taking it away anyhow. In other words, whether I was there or not, I was only a spectator, the property was being taken away.
But while this would be a soul-crushing experience for most, it seemed to have an unexpected response by Soros. Instead of seeking comfort in routine and normalcy, young Soros found something different, a peculiar kind of freedom in chaos. While his peers tried to make sense of their shattered world through conventional means, he began to see patterns in the breakdown of social order. All of this might have been the start of one of Soros' biggest discoveries about the world.
Soros realized that you don't actually need to change the laws, you just need to change how they're enforced. If nobody chooses to enforce the law, or the laws are differentially enforced, it's like changing the laws.
But first, Soros would need to learn how to beat the markets, and to do this he had to learn about reflexivity. Reflexivity. Have you heard of the theory of reflexivity? This seemingly simple concept would become the cornerstone of one of the most successful investment strategies in history. To understand it, we need to follow a young George Soros to post-war London. In 1947, while most 17-year-olds were settling back into peaceful lives, Soros made a decision that would alter the course of financial history. He left Hungary for London. Despite his privileged background, his early days in Britain were far from glamorous. Working as a railway porter and nightclub waiter, he experienced poverty firsthand. But his luck changed in 1949 when Soros secured a place at the prestigious London School of Economics, an institution that had already produced numerous world leaders. The halls he walked had been graced by figures like John F. Kennedy, Pierre Trudeau, and Lee Kuan Yew. But it wasn't the illustrious alumni that would shape Soros's future. It was his encounter with philosopher Karl Popper. Popper, a fellow Austrian Jewish émigré, became more than just a mentor to Soros. Popper's most influential work, The Open Society and Its Enemies, published in 1945, arrived at exactly the right moment for young Soros.
Und was ich bei der offenen Gesellschaft gemeint habe, war eine Gesellschaft, sagen wir, in der man frei atmen kann, frei denken kann, in der jeder Mensch einen Wert hat und in der die Gesellschaft keine überflüssigen Zwänge über die Menschen ausübt.
The book presented a devastating critique of historical determinism, the idea that history follows predictable patterns and moves towards a predetermined end. This was the foundation of both Nazi and communist ideology, systems that Soros had personally experienced.
Ende sind hauptsächlich die Faschisten, die Nazis und aber auch die kommunistische Diktatur.
Instead, Popper proposed something revolutionary. All human knowledge is provisional. No matter how certain we are about something, we might be wrong.
Eine wissenschaftliche Theorie ist vielleicht wahr im Sinne des absoluten Wahrheitsbegriffes, aber wir können es nicht beweisen. Wir wissen nicht, ob sie wahr ist. Alles, was wir sagen können, ist, dass sie sich bewährt. Aber wir haben die Wahrheit sozusagen nicht in der Tasche. Und sogar wenn wir sie in der Tasche haben, kennen wir sie nicht als wahr. Können wir sie nicht als wahr identifizieren.
This concept, which he called Fallibilism, would later become crucial to Soros's market strategies. Think about what this meant to a young man who had just survived the Nazi regime. While most people sought certainty in an uncertain world, Popper was saying that uncertainty itself was the only certainty. For Soros, who had seen how the certainties of Hungarian society had crumbled, this rang profoundly true. Popper taught that knowledge advances not through proof, but through disproof. We can never be certain that a theory is true, but we can prove it false. This idea would later influence how Soros approached market analysis. Instead of trying to prove his investment theories right, he would constantly look for ways they might be wrong. This understanding gave Soros a unique edge. While other traders were trying to determine if their analysis was right, Soros was watching how other people's beliefs, right or wrong, were creating new market realities. He wasn't just predicting the market. He was predicting how people's predictions would change the market. This was the birth of the theory of reflexivity.
Reflexive situation, participants' views can't correspond to reality because reality is not something independently given. It's contingent on the participants' views and decisions. The decisions, in turn, can't be based on knowledge alone. They must contain some element of bias or guesswork about the future, because the future is contingent on the participants' decisions. The future can't be known until it has actually occurred.
At its core, reflexivity suggests that there's a two-way feedback loop between perception and reality. But what does that even mean? Imagine you're standing in front of a mirror at a funhouse. Traditional economists would tell you that the mirror simply reflects what's in front of it, you. But Soros saw something different. He noticed that when people see themselves as distorted in the mirror, taller, shorter, wider, they unconsciously adjust their posture. They stand differently, move differently, And in doing so, they change the reality that the mirror is reflecting. And how does this apply to markets? When investors believe a stock will rise, they buy it. Their buying pushes the price up, which convinces more people the stock is valuable, leading to more buying. The perception creates a new reality, which then reinforces the original perception. Just like that person in the funhouse, adjusting their stance based on what they see in the mirror. But here's where it gets fascinating. Soros realized that this wasn't just a simple loop. Sometimes the reflection could become so distorted that it would eventually shatter the very reality it was creating. Think of a company whose stock price rises not because of real value, but because everyone believes it will rise. Eventually, this gap between perception and fundamental reality grows too large, and the bubble bursts. This understanding gave Soros an edge that few others had. He wasn't just watching the market, or even the underlying assets. He was watching how people watched the market, and how their watching changed what they were watching. It was like being able to step outside the funhouse and see both the mirror and the person, understanding how each was influencing the other. He would later say that what allowed him to see this clearly were the skills he learned in Nazi-occupied Hungary. To survive in Nazi-occupied Hungary, I had to learn to view events from afar, even when they directly affected me. This detachment became invaluable in understanding market dynamics. As 1956 approached, Soros had evolved beyond a simple immigrant success story. Armed with Popper's philosophical framework and his own theory of reflexivity, he was ready for his next move. While others saw the financial markets as rigid systems governed by unchangeable rules, Soros saw them as malleable constructs shaped by human psychology. But how can you use these theories in the real world to make billions? How did Soros do it? Have you ever lost $10 on a scratcher? And you feel that familiar sense of regret, the voice in your head saying, "I should have known better." Well, this also happens to Soros, but instead of $10, he loses $250 million. The difference is that made him learn the secret that made him $1 billion in just 1 week, betting against the United Kingdom. And this is how it unfolded. The promising LSE graduate's first steps into finance weren't exactly glamorous. At Singer and Friedlander, Soros started as a clerk, filing papers and running errands. Despite his theoretical understanding, he struggled with the practical aspects of banking. In fact, he found the work so unfulfilling that he nearly quit the industry altogether. Mid-50s America was experiencing an unprecedented economic boom. While Europe was still recovering from the war, the United States had emerged as the world's undisputed financial powerhouse. Wall Street was entering what would later be known as its golden age, and New York had become the epicenter of global finance. For Soros, the timing couldn't have been better. Europe's markets were still constrained by post-war regulations and old-world thinking. But America offered something different, a more dynamic, less rigid financial system where new ideas could flourish. When he landed a position at FM Mayer, it wasn't the role itself that excited him. It was the possibility of trading European securities in this new environment. Once again, in the beginning, he wasn't particularly successful. His complex theories often seemed at odds with the practical realities of trading. While other traders focused on simple buy low, sell high strategies, Soros was trying to apply philosophical concepts to market movements. Many of his colleagues found his approaches bewildering, even absurd. The move to Wertheim and Company in 1959 marked a turning point. Unlike FM Mayer, where he was just another trader, Wertheim gave Soros more freedom to develop his own strategies, but freedom didn't immediately translate to success. In the early 1960s, Wall Street was experiencing a peculiar phenomenon. American investors were starting to look at European markets, which were trading at significant discounts compared to their US counterparts. Most traders saw this as a simple pricing mismatch. Soros saw an opportunity to apply his theory of reflexivity. His first significant success came from trading German securities trading in both London and Frankfurt. While others struggled with the complexity of dealing with post-war German regulations, Soros's European background gave him an edge in understanding not just the markets, but the psychological and political factors at play. By 1963, he had developed a reputation as the European securities guy at Wertheim. But this wasn't enough. He could see that arbitrage alone wouldn't give him the returns he envisioned. The real opportunity, he believed, laid in anticipating how American investors' growing interest in European markets would create a self-reinforcing cycle of investment and growth. The First Eagle Fund was Soros's first chance to fully implement his strategies. Starting with just $4 million, he began making concentrated bets on European securities. Unlike traditional fund managers who diversified broadly, Soros made bigger bets on fewer positions. His theory? If you understand how market psychology works, diversification is just a way of admitting you don't know what you're doing. Warren Buffett would put it later,
diversification is a protection against ignorance.
And Soros was not ignorant. His approach worked. By 1969, First Eagle had grown to over $20 million in assets, a testament to his unconventional strategies. But success brought its own constraints. First Eagle's growth meant more oversight from Arnhold and S. Bleichroder, more restrictions, more people looking over his shoulder. Soros needed something different, a vehicle that would give him the freedom to make the aggressive moves his reflexivity theory demanded. Enter the Double Eagle Fund. Starting with $12 million of the wealthiest First Eagle investors who followed Soros to his new venture, this fund was designed for what Soros called the big play. No more tiptoeing around institutional guidelines. This fund could use leverage, short selling, and currency plays. Everything Soros needed to exploit the market's psychological weak points. This wasn't just about making money anymore. Double Eagle was Soros's laboratory for testing how far he could push market psychology. How much pressure could a currency take before it broke? How long could market perception stay divorced from reality before something snapped? The results were staggering. By 1973, the fund had grown to $50 million, and Soros knew he needed complete independence. He left Arnhold and S. Bleichroder to establish Soros Fund Management, renaming Double Eagle to the Soros Fund. Later, inspired by the physics principles that seemed to mirror his theory of market behavior, he would rename it again to the Quantum Fund. Under its new identity, the fund's growth accelerated. By 1979, just before Soros would make his first major currency play, the Quantum Fund was managing over $100 million. His theory of reflexivity was no longer just a philosophy. It was proving to be one of the most profitable investment strategies in history. Throughout the 1980s, Soros would refine his approach, scaling up his bets with each success. The Quantum Fund grew at an astonishing rate, from $200 million to nearly $1 billion by the mid-80s. Each trade bigger than the last, each success building towards something unprecedented. But more importantly, Soros had discovered something that would change everything. Currencies were the perfect playground for his theories. Unlike stocks, which were anchored to company assets and earnings, currencies floated on pure psychology. There were no quarterly reports, no price-to-earnings ratios, no tangible assets to value. Just the collective belief of market participants, and beliefs, as Soros had learned long ago in Budapest, could change very quickly. Soros seemed unstoppable, but then came October 19, 1987.
Today is Black Monday, the day the Dow dropped more than 500 points.
As the Dow Jones Industrials took off on a fear-fed freefall to close down a record 508.32 points.
It's the day the Dow dropped more than 22%.
Panicked traders worked through lunch hours in a desperate but losing attempt to keep up with tickers that rolled up an all-time high volume.
They're calling it the Monday Massacre, the worst drop in Wall Street history.
Markets had been jittery for weeks. Stock valuations were stretched, and tensions in the Persian Gulf had investors on edge. But no one, not even Soros, expected what happened next. In a single day, the Dow Jones dropped 22.6%. 2 decades of bull market confidence vanished in hours. For Soros, who had built massive positions betting on continued market strength, it was devastating. The Quantum Fund lost $250 million in just one day. Instead of retreating, he analyzed his mistake. The problem wasn't his theory of reflexivity, it was how he'd applied it. He'd forgotten his own lesson. Markets could move in both directions. Just as positive feedback loops could drive prices up, they could drive them down even faster. Fear was an even more powerful force than greed. I was ahead of myself, Soros would later write. I had developed an exceptionally successful investment strategy, but allowed my success to go to my head. I had started to take more risks than I should have. Instead of breaking him, Black Monday made Soros stronger. He restructured his approach, putting as much emphasis on preserving capital as making profits. By 1988, the Quantum Fund had not only recovered its losses but was growing faster than ever. Soros had learned to wait patiently for the perfect setup, what he called the big play. He wouldn't have to wait long, as he was about to completely break the Bank of England.
Today has been an extremely difficult and turbulent day. Massive speculative flows continue to disrupt the functioning of exchange rate mechanism.
The pound will now be left to find its own level in the markets, inevitably below the ERM floor, which the government was pledged to defend.
The European exchange rate mechanism was about to provide him with the opportunity of a lifetime. But this time, he wouldn't just bet against a currency. He would take on the Bank of England itself. To understand how Soros managed to break the Bank of England, we need to understand what made the British pound vulnerable in the first place. It wasn't just one thing. It was a perfect convergence of politics, economics, and most importantly, rigid thinking. The European exchange rate mechanism, ERM, was supposed to be Europe's path to monetary stability. The idea was simple. Participating countries would tie their currencies to the German Deutsche Mark, keeping exchange rates within strict bands. For Britain, this meant keeping the pound above 2.778 German marks. There was just one problem. Germany and Britain were moving in opposite directions. The Berlin Wall had fallen, and Germany was spending heavily on reunification, driving up inflation. To combat this, the Bundesbank, Germany's central bank, kept interest rates high. Britain, meanwhile, was in recession. They desperately needed lower interest rates to stimulate their economy. But to keep the pound within the ERM bands, they had to match Germany's high rates. Enter John Major, Britain's Prime Minister. He had staked his political reputation on keeping Britain in the ERM. The pound would stay in the ERM, he declared. If it takes interest rates at 15%, so be it. Soros saw something familiar in this stance, the same rigid thinking he'd encountered in his youth. Just as the Hungarian authorities had tried to maintain their power through inflexible rules, the British government was trying to maintain an artificial exchange rate through sheer force of will. The pressure was building. British unemployment was rising, property prices were falling, businesses were going bankrupt, the trade deficit was growing, but still the government insisted the pound would not leave the ERM. To Soros, this wasn't just an opportunity, it was reflexivity theory playing out on a national scale. The more Britain insisted on maintaining the exchange rate, the more obvious it became that they couldn't maintain it. The more obvious it became, the more traders would bet against it. And the more traders bet against it, the more expensive it would become to defend. Then came the interview that changed everything. The president of the Bundesbank gave an interview suggesting certain currencies might need to be devalued. He didn't mention the pound specifically. He didn't need to. The market got the message. Soros knew. This was the moment he'd been waiting for. The big play was about to begin. Most traders would have started small, testing the waters. But not Soros. He bet everything. What most people don't realize is that Soros wasn't betting just his own money. Through a complex web of currency forwards and futures contracts, he was able to control far more pounds than he actually had to put up in cash. For every dollar the Quantum Fund had, Soros could control $10 worth of pounds sterling. This leverage was the key to everything. The initial position was staggering, $1.5 billion short against the pound, but that was just the start. Through careful use of derivatives and credit lines from multiple banks, Soros kept increasing his position. $2 billion, $3 billion. Eventually, he had built a $10 billion position betting against the pound sterling, with only about $1 billion in actual capital at risk. The banks were willing to extend this much credit because of Soros's track record, and ironically, because they believed the Bank of England would never let the pound fail. The same market psychology that made the pound vulnerable was making it possible for Soros to build his massive position against it. The Bank of England fought back with every weapon in their arsenal. As European markets opened at 6 a.m., they began massive purchases of pounds using their foreign currency reserves. Within the first hour, $1 billion spent. By 8:30 a.m., another 2 billion. Every time traders sold pounds, the bank was there to buy them. But for every pound they purchased, more sellers emerged from the shadows. When buying pounds wasn't enough, they turned to interest rates. At 10:15 a.m., the first emergency announcement echoed across trading floors. Rates jumped to 12%. The market barely flinched. The Bank of England's message was clear. We will do whatever it takes to defend the pound. By 11 a.m., 5 billion in reserves had been spent. Traders could smell blood in the water. At 12:30 p.m., the bank made another desperate announcement. Britain would borrow up to $15 billion from European central banks to defend the pound. The market's response? More selling. To understand the desperation of their next move, imagine what happened at 2:15 p.m. Rates hiked again, now to 15%. The Bank of England was essentially telling the market they were willing to strangle the British economy to defend the pound's value. Homeowners would see their monthly payments double. Businesses already struggling with recession would face crushing borrowing costs. But Soros had seen this before. He'd learned that when central banks resort to extreme measures, it usually means they're running out of options. The bank was trying to project strength, but these desperate moves only confirmed the pound's weakness. By 3:30 p.m., reports leaked that the bank had spent nearly all borrowed reserves. Trading floors across London descended into chaos. Emergency meetings began at Downing Street at 4 p.m. The whispers started. Chancellor Norman Lamont was drafting a statement. At 7 p.m., after spending over $15 billion in reserves and pushing interest rates to breaking point, Lamont appeared before the press. His face told the story before he spoke a word. Britain was leaving the ERM. The pound would be allowed to float freely. Within hours, the pound plummeted 15% against the Deutsche Mark and 25% against the dollar. The Bank of England, one of the most powerful financial institutions in the world, had been broken. A single day's trading had rewritten the rules of global finance. When markets finally settled, the numbers were staggering. In a single day, Soros's quantum fund had made $1 billion. By the time they closed all positions over the next few weeks, profits would swell to over $2 billion. A sum so large it was difficult to comprehend. More money than most banks made in a year, earned in just a few weeks of trading. But the impact went far beyond money. The fall of the pound sent tremors through the entire European monetary system. Within months, the Italian lira and Spanish peseta were forced to devalue. The French franc came under intense pressure. The dream of European monetary stability was crumbling. For other central banks, the message was clear. If the Bank of England could be broken, anyone could. The age of untouchable central banks was over. In the new world of global finance, market psychology was more powerful than government decree. Soros was thrust into the spotlight. Newspapers dubbed him the man who broke the Bank of England. Some called him a financial terrorist. Others hailed him as a market genius. But most missed the real significance of what had happened. This wasn't just about one man making a fortune. It was about the changing nature of global finance. The walls between national economies were coming down. Capital could flow across borders at the press of a button. In this new world, trying to maintain artificial exchange rates was like trying to hold back the tide. The trade changed everything. For Soros, it marked a transition. He was no longer just a successful investor. He was now a figure of global significance. The quantum fund's assets swelled as investors clamored to get in. By 1993, it was managing over $4 billion, making returns that seemed impossible to most investors. But more importantly, the trade proved something Soros had long suspected. The global financial system was far more fragile than anyone realized. The same psychological forces he'd identified in his theory of reflexivity could now operate on a global scale, with consequences that could shake entire nations. The Bank of England trade changed more than just Soros's bank account. It changed his worldview, but it wasn't his last big play. In 1993, he doubled down, betting against several European currencies. When the French franc came under pressure, he made another $750 million. But the constant pressure of managing billions was taking its toll. In 1994, Soros stepped back from day-to-day management of the quantum fund, handing the reins to his protege Stanley Druckenmiller. He wanted to focus on writing and his growing philanthropic work. When the Asian financial crisis hit, Soros couldn't resist. He returned to active trading, betting against the Thai baht and Malaysian ringgit. But this time the backlash was fierce. Malaysian Prime Minister Mahathir Mohamad publicly accused him of destroying Asian economies. The financial terrorist label stuck. The quantum fund lost heavily in the dot-com crash, dropping 22% and leading to a major restructuring. Druckenmiller departed, and Soros returned to stabilize the ship. By 2002, he had reorganized the fund into a less aggressive family office structure. During the 2008 financial crisis, Soros came out of retirement again. He made $1.1 billion betting against the British pound, again, and the Australian dollar. In 2011, he returned one final time to protect his wealth during the European debt crisis, before closing Quantum to outside investors and converting it into a family office managing his own $24.5 billion fortune. By the time Soros fully stepped back from trading, his quantum fund had generated over $40 billion in profits. More importantly, he had proven that markets weren't just mathematical equations, they were psychological battlegrounds where perception could become reality. What would you do with $40 billion? Would you buy the biggest mansions, yachts, cars, and everything you ever wished? Or would you bend society to your will? Is $40 billion enough to change the rules? Well, it is, if you ask Soros. You see, Soros had always had a bit of a god complex, and now he had the money and connections to shape the world how he wanted. But how would he do this? It began modestly in 1984 with a simple idea: give photocopiers to Hungarian universities and libraries. Under communist rule, the government controlled all copying machines, limiting the spread of information. Soros's first foundation spent $3 million breaking this monopoly on information. By 1987, his foundations were spending over $20 million annually in Eastern Europe. But it wasn't just about the money, it was about building networks. In each country, Soros established autonomous foundations led by local intellectuals and activists. They knew the terrain, understood the needs, and could spot opportunities for promoting what he considered democratic values. When the Soviet Union fell, Soros seized the moment. Between 1991 and 1994, he poured over $4 billion into Eastern Europe and the former Soviet states. In Russia alone, his foundation spent $1 billion on everything from rewriting textbooks to supporting scientific research. The foundation provided emergency support to keep scientists working, preventing a brain drain that could have set Russian science back decades. Soros's foundations promoted a specific vision of society, drawn directly from his mentor Karl Popper. An open society meant more than just democracy. It meant transparent institutions, free media, civil rights, and, most importantly, the acceptance that no one had a monopoly on truth. Every belief, every policy, every institution should be open to critical examination and change. By the late 1990s, the Open Society Network had become a global force, operating in over 70 countries. In South Africa, it supported the transition from apartheid. In Myanmar, it funded pro-democracy groups. In the United States, it tackled issues from drug policy reform to criminal justice. The annual budget grew to over $1 billion. By the 2000s, the Open Society Foundations had become one of the largest philanthropic organizations in history, second only to the Gates Foundation. Soros's annual contributions grew steadily, reaching over $18 billion in 2017. A transfer of most of his fortune to the foundation that marked one of the largest transfers of wealth from an individual to a foundation ever. In 2004, Soros made his first major foray into US politics, spending $27 million in an attempt to defeat President George W. Bush's re-election bid. This was just the beginning. He established Democracy Alliance, a network of wealthy donors supporting progressive causes, and began funding a vast network of political action committees and advocacy groups. The Open Society's approach in America was systematic. Rather than just funding campaigns, Soros built infrastructure, think tanks, advocacy groups, and media organizations. He poured millions into organizations like the American Civil Liberties Union, Planned Parenthood, and Black Lives Matter. State by state, issue by issue, the foundation worked to shape policy from the ground up. By 2016, Soros's political giving had evolved. He committed over $25 million to Hillary Clinton's campaign and other Democratic candidates. When that effort failed, he doubled down. In 2020, he committed over $70 million to election-related causes, focusing particularly on voter registration, turnout efforts, and supporting progressive prosecutors in local elections. Although the numbers are not yet final, it's estimated that another $60 million were donated by Soros in 2024, backing Kamala. It seemed Soros investments were mixed with some wins and some losses, but actually Soros was winning big. Take a closer look at the following clip.
Well, he's doing things that erode the fabric of civilization. Getting DAs elected who refuse to prosecute crime. That's part of the problem in San Francisco and LA and a bunch of other cities. So why would you do that? Soros realized that you don't actually need to change the laws, you just need to change how they're enforced. If nobody chooses to enforce the law, or the laws are differentially enforced, it's like changing the laws.
You see, the greatest discovery of Soros was not his reflexivity theory. His biggest discovery was understanding that you don't actually need to change the laws, but rather the law enforcement. Think about that. Imagine you want to change society, but most people don't agree with you. Let's say you wanted to make stealing legal. If everyone agrees that stealing is a crime but no one punishes you when you steal, is this really a law? So rather than spending his money on convincing people to change their mind and change the laws, Soros could just make sure no one was convicted on the matters he wanted to change. This vision probably came from Soros' past, where he saw that laws could break systems to a point where they are rotten, but only if people complied. His younger self was saved by people who broke the law because they were against it, and thus came the idea that controlling people that enforce the law is much more powerful than changing the law. And this also comes with another advantage. It's cheap. Instead of spending all your money betting on the president, you can fund causes at a much lower level for much less money, with much more impact, and ensure they are still enforced no matter who's in power. For example, if district attorneys started being too lenient on crime, laws would not be enforced as they should. And although it's hard to really know, some people, like Elon, believe Soros is getting DAs that refuse to prosecute crime elected. Another instance of this discovery applied can be seen on the 2024 elections. Between 2016 and 2020 alone, the Open Society Foundations committed over $140 million to voting-related causes. Rather than just funding registration drives, Soros supported organizations working to remove barriers to voting. This included challenging voter ID laws, supporting automatic voter registration initiatives, and backing legal efforts to fight what his foundation called voter suppression tactics. This meant that non-citizens voting were not actually committing any crime, because no one was checking, and this in turn could get more votes to the cause that gave them the opportunity to vote. And this was arguably Soros' greatest discovery. You can change the laws without changing laws, and in this way you can shape society in whatever way you see fit. This is how Soros became the man that owns you. But why would Soros do this, and potentially create systems that could ruin society as we know it?
In my opinion, he fundamentally hates humanity. That's my opinion. Well, he's doing things that erode the fabric of civilization.
But Soros is not alone. No, there is someone else pushing the DEI agenda. Thank you for watching. If you want to help us, send this video to someone that might find it interesting. See you next time.